Imagine a portfolio that can grow your wealth by 12 to 15% annually over the next decade while you sleep. Sounds too good to be true? Well, I've personally invested $5,000 in this exact strategy over the last 3 months, and today I'm going to break down the 6 best ETFs you should buy in 2024 to achieve the same goal. Whether you are a beginner or seasoned investor, stick around. This is your roadmap to financial success through ETFs. Trust me, you don't want to miss this. Welcome back to the channel. Here we turn complex financial concepts into simple, actionable steps to grow your wealth. I'm Dominic, and today we are diving into ETFs, one of the smartest, low-risk ways to invest in the stock market. I've built my own ETF portfolio designed for high returns over the next decade, and I'm going to show you why these 6 ETFs have made the cut. By the end of this video, you will know exactly which ETFs to buy, how much to allocate, and how these funds will work together to help you reach your financial goals. Ready? Number 1. CSPX S&P 500, 50% of my portfolio. The backbone of any solid ETF portfolio is a diversified index fund, and for me, that's the CSPX ETF, which tracks the S&P 500. This isn't just any index, this is a collection of the 500 largest companies in the US, representing industries like tech, healthcare and finance. I've allocated 50% of my portfolio to this ETF because it offers steady growth with relatively low risk. Why the S&P 500 over global or European? Simply put, the global index is too diluted and European markets tend to be overregulated, leading to lower returns. The S&P 500 is the sweet spot, offering high diversification while still delivering solid returns. Historically, it has provided an average of 10% per year, but with tech and AI innovations, I'm expecting closer to 12 to 15% annually in the next decade. As you can see from this graph, the S&P 500 has shown consistent growth, especially over the last 10 years. The 2020 dip during the pandemic was quickly followed by a sharp recovery, providing the resilience of this index. Apple, Microsoft, and Amazon make up some of the top holdings here. Imagine owning a slice of these industry giants and watching your wealth grow every time they innovate. Now, you can't talk about future growth without mentioning the tech sector, and the best way to capture this is through the CNDX ETF, which tracks the Nasdaq 100. This ETF includes the 100 largest non-financial companies listed on Nasdaq. Focusing on the tech sector, think Apple, Tesla, and Nvidia. I've allocated 20% of my portfolio to this ETF because tech is dominating the world, and with AI and other advancements, it's only going to get bigger. Despite high valuations, if you are building a portfolio for next 10 years, this ETF is a must-have. I'm aiming for 15% annual returns with this one, and I believe tech will continue to lead the way. Notice the sharp incline in Nasdaq's performance. This is largely driven by tech companies. Over the last 5 years, the Nasdaq 100 has consistently outperformed the S&P 500 thanks to high-growth tech firms. AI is transforming industries as we speak. Just look at how companies like Microsoft and Google are integrating AI into their operations. Being invested in tech through CNDX positions you to benefit from these advancements. Next, we are spicing things up with a small cap value ETF, ZPRV, which targets small US companies that are undervalued. These companies tend to outperform large cap stocks, especially during economic recoveries. I've allocated 10% of my portfolio to this ETF because small cap stocks often offer higher returns than the S&P 500 over the long term. Why small cap value? Because these are companies that are often overlooked, but when they perform well, they can outperform big name stocks. It's a strategic play that adds some risk but also offers significant upside potential. This chart shows how small cap stocks often outshine large cap stocks, especially during time of recovery. Investing in these companies gives you an exposure to firms that can grow exponentially as the economy strengthens. Think of companies like Ulta Beauty or Greco, firms that aren't household names but are growing rapidly. You want a slice of this allocation for those high growth opportunities. While most of my portfolio is US based, I can't ignore the growth potential in Asia. That's where the 5MVL ETF comes in, focusing on value stocks from Asia and emerging markets. With 10% of my portfolio allocated here, this is my way of diversifying globally. The US market is strong, but Asia, with its growing middle class and booming economies, is where the next big wave of growth is likely to come from. Why not Europe? Europe's markets are overregulated and have historically shown lower returns, so I've chosen to bet on Asia instead. This ETF gives exposure to value stocks in countries like China, South Korea and India. As you can see, this ETF provides broad exposure to emerging markets, which are said to be the next engines of global economic growth. This diversification helps reduce risk by spreading investments across multiple regions. Look at Alibaba or Samsung. These are just two of the powerhouses driving innovation and growth in Asia. This ETF allows you to tap into that without betting on individual companies. Next up is the KEWEB ETF, which focuses on Chinese tech companies. China's tech sector has taken a beating recently, making it a great opportunity to buy low. With 5% of my portfolio invested here, this is more of a high risk, high reward play, but given China's ambition in the tech space, I believe it will pay off in the long run. Companies like Tencent and Alibaba dominate this ETF, and although they have faced regulatory challenges, the long-term growth potential is enormous. Looking at this chart, it's clear that Chinese tech stocks have taken a hit in recent years. But remember, buying when prices are low can lead to massive upside when the market recovers. This ETF is a strategic play for long-term growth. Tencent is often referred to as the Facebook of China, and their hold on the market is only growing. Getting in now could offer some serious upside. Finally, I have allocated 5% of my portfolio to the VVSM ETF, which focuses on semiconductor companies. These companies are the backbone of all tech. Every gadget, phone or AI tool needs semiconductors. As we move into an increasingly digital and automated world, this sector is going to boom. Rather than trying to pick individual winners like Nvidia or Intel, this ETF allows me to own the entire sector, hedging my bets across multiple companies that will for sure shape the next decade. According to this projection, the semiconductor market is expected to grow significantly, especially with the rise of an AI and 5G technologies. This ETF allows me to capitalize on that growth without needing to bet on a single company. Think about the last time you upgraded your phone. Semiconductors were crucial to making that device faster, smarter and more efficient. Imagine the gains you could see from investing in the companies powering that progress. So there you have it, my top 6 ETFs for 2024 and how I've allocated my 5,000. These ETFs offer a solid mix of growth, value and geographic diversification, making them perfect for anyone looking to build a portfolio for the next 10 years. If you want to see how these perform over time, make sure to hit that subscribe button for updates and don't forget to give this video a thumbs up if you found this helpful. Let's grow our wealth together. Until next time, happy investing.